Today, we're diving into a forecast that looks at 2026 not just another year on the calendar, but as a massive structural turning point for the entire global market. The core idea? A great winter is coming. And this isn't about weather, it's about a fundamental rewiring of a system that's been running for the last 100 years. Let's get into what that really means. So the central metaphor we need to understand is this conjunctive winter. Now, this isn't your garden variety recession. We're talking about the end of a massive, long-wave economic cycle. This winter phase means a really painful period of debt deflation, rising global tensions, and major social shifts. The analysis is pulling no punches here. The stakes are incredibly high. All right, Section 1, Kondratiev's winter. Let's really dig into why the argument is that this isn't just a downturn, but a moment that completely changes the rules of the game. You know, a huge piece of this forecast is what's being called the death of Homo economicus. That's the old idea of the perfectly rational investor who always makes calculated decisions. Well, this analysis says that's over. Major market moves are now being driven by something much more primal, raw survival instincts and the psychology of the crowd. So if the markets are just pure chaos, how on earth are we supposed to navigate them? Well, this analysis uses 5 specific lenses to try and separate the signal from all that noise. Okay, so here are the 5 tools in the toolkit for making sense of the chaos. First up, we've got Dewey's cycles, which is where that whole Kondratief winter idea of huge boom and bust waves comes from. Second is Dweck's instinct, the theory that says collective panic now trumps logic. Third, Casti's socionomics, which suggests that the general mood of society can actually predict where markets and politics are headed. Fourth is Amos's fiat analysis, which looks at how government money printing and intervention mess with the market's true signals. And finally, Fisher's psychology, which sees market behavior as this repeating dance of crowd psychology. It's really important to keep these 5 ideas in your head because they're the foundation for everything we're about to look at. All right, next up, we're turning to what might be the single biggest battleground in 2026, artificial intelligence. And the forecast here is really a tale of 2 halves. Wild optimism smashing right into the fear of a bubble. This slide really nails the core idea for AI. The first half of 2026 is all about what's called the inertia of CapEx. Think of all the massive pre-planned spending on data centers and chips. That stuff keeps the optimism train rolling. But then, in the second half of the year, the mood completely shifts. The market starts asking, okay, where's the profit? That's when the fear of ROI, the fear of return on investment, kicks in, and people start worrying that all that money was poorly spent. And just to give you a sense of the scale we're talking about, look at this number, $24 billion. That's what Micron is investing in just one new plant in Singapore. This is a perfect example of that inertia of CapEx. Capital flows this huge don't just stop on a dime. They're going to prop up the hardware side of AI well into 2026, no matter what. But here's the canary in the coal mine. One of the clearest signals that a market top might be getting close is insider selling. When you see executives at major tech companies start selling off huge chunks of their own stock, it suggests that the smart money, the people who actually know what's going on inside the company, are quietly heading for the exits while everyone else is still euphoric. This is the big red flag that validates that second half fear of ROI. So with this AI paradox playing out, let's zoom out and look at the bigger picture. How is all this going to ripple through the major global markets in 2026? For the US, the forecast is calling it a Trump trade 2.0. In the first half of the year, you might see stocks rally on hopes of things like tax cuts. But then, in the second half, the inflation caused by new tariffs could really start eating into company profits, trapping the market in a sideways grind. And for bonds, the fear of inflation and government debt could bring back the so-called bond vigilantes, pushing those 10-year yields up towards 5%. Now, the outlook for South Korea is, well, particularly tough, according to this analysis. The idea of a 25% U.S. tariff could create a massive export shock, hitting their super important car and battery industries head-on. That could put serious downward pressure on the KSPI as foreign money flees. And then the central bank is stuck between a rock and a hard place. Do they raise rates to fight inflation or cut them to fight a recession? There's no good answer. And this number right here is absolutely critical, 1,451 to the dollar. That's seen as a huge psychological line in the sand. If the currency breaks above that and stays there, it would signal that we've entered a whole new era of structural weakness for the won, a very real, very direct consequence of all these pressures. Meanwhile, over in Europe and China, the picture isn't much brighter. The EU and UK are facing what's being called the disappearance of growth. You've got weak consumer signals from luxury giants like LVMH, plus the constant threat of US tariffs. Over in China, the story is about the limits of stimulus. The government can pump in as much money as it wants, but if domestic demand stays weak and foreign investors keep pulling out due to geopolitical risk, there's a hard cap on any real recovery. So, after all that forecasting, what's the actual takeaway? What are we supposed to do with this information? This final section lays out the idea of a survival portfolio designed for navigating this predicted winter. The most important thing to grasp here is a complete mindset shift. It's about moving from trying to get a return on your capital to making sure you get the return of your capital. And that leads to 3 key principles. 1, be really careful about companies propped up by government money or tariffs. 2, don't get swept up in crowd madness like meme stocks. And 3, actively protect yourself against volatility with things like cash and assets that are less tied to geopolitics. And all of this leaves us with a final, really important question. This analysis paints a vivid picture of a world where the old way of doing things is breaking down. It suggests that being prepared and really understanding these big cycles is going to be the key to navigating whatever comes next. So, as the old order reorganizes, what will you prepare for?